Now, before I start, I'd like to say a quick thank you to our sponsor, Net Wealth. Now, Net Wealth's wealth management service combines a comprehensive, low-cost investment solution with access to qualified advisors. They recently launched My Net Wealth, which is a digital dashboard that combines all your savings and investments from multiple providers in one place. Their My Net Wealth's Wealth Planner tool helps you visualize your current wealth and apply it to your future needs. It takes into account various factors such as age, investments, pensions, tax wrappers, and expected contributions or withdrawals, and calculates the likelihood of you achieving your goals. And daily updates make it easy to track the value and performance of your wealth. Now, I've used a demo of these tools, and they provide a great way to introduce high-level cash flow planning into your personal finances. My Net Wealth also provides a library of useful personal finance content, and if you ever need advice or guidance, their highly qualified team is always there to help. You can find out more information about Net Wealth and sign up for My Net Wealth in 30 seconds by visiting mynetwealth.com. Please remember, the value of your investments can go down as well as up, so you may get back less than you invest.
Hello and welcome to episode 418 of the Money to the Masses podcast with your resident expert, as always, Damien Fay and me, Andy Leaks. Damien, welcome back. How are you doing?
I'm good. Been a busy week, Andy. I went down to Brighton again, a place I've not been to hardly ever, and I've been there twice now in as many months. So I went and took part in a pension roadshow down in Brighton. So that was fun. Live audience. I always do like doing these shows in front of live audiences who can put you on the spot, ask you questions, as I was part of a panel of experts. So that is inspiring a piece on the podcast this week, which I'll come on to. But before we do that, you've got a number of reviews to read out. So all of these reviews, Andy's going to go through them. Do write in if you've provided the review, as you will be getting a Money to the Masses mug. Just tell us your address. Write into damien@moneytothemasses.com. And we do find them inspiring. So please do send in your reviews on the app that you use, and we'll look at them, share them among the team, and read out the best of them.
Okay, so the first one, the title was fantastic, and it goes on to say, my fiance knew nothing about personal finance before your pod. Now she is advising me on it. And that's all thanks to the pod. So short and sweet, thank you for that. The next one is titled Best in Class, and it goes on to say, this is a great personal finance podcast. What I really like is that they really research and dig into different topics and don't just trot out the latest finance news as some podcasts do. I listen to a lot of personal finance podcasts, but this one has become a firm favourite. Thank you, Money to the Masses. And moving on to the final one. This is actually one that we received on the back of last week's pod, and it says, hi guys, thanks so much for your last podcast. I thought I was the only one who knew all of these numbers. Nice to know that you guys keep track of it all as well. Thanks again, guys. Great podcast. And that was from Simon2685. So some really good feedback there, Damien. And so if any of those were your reviews, please do email us and claim it, and we will send out a Money to the Masses mug. Just email me or Damien. It's Andy or Damien at moneytothemasses.com, and we'll get that sorted. Right, so what have we got coming up on this week's show?
So the first piece I'm going to be doing is an investment piece, and it's about a concept called value averaging, not pound cost averaging. This is something different. It's an alternative strategy to use when trying to attain a set target in the future, a set amount of money you're trying to build. The next piece I'm going to be doing is inspired by the recent live events I've been doing. So I get asked lots of questions, and it became apparent there are quite a few topics that people ask questions around. So I'm going to go through a range of those questions, somewhat at random, but they are the frequently asked questions I get around pensions, pension contributions, and pension savings. And the final piece of the podcast, Andy, you're going to be doing.
Yes, so I'm going to be providing a quick update on what is happening with house prices at the moment, because there has been some data that's been released this week that is actually quite significant. So we're going to explain why and talk through those numbers. So value averaging then, Damien, what is it?
So let's say you're going to start investing, and one option is obviously to invest a lump sum up front. But we've talked about on the podcast numerous times a strategy where you could pound cost average. So you drip your money into the market. So that is where you might take a lump sum that you want to invest, you break it down into equal installments spread over an equal number of months. For example, let's say you had £10,000 and you decide to drip the money into the market over a 10-month period, that would mean you would put in £1,000 a month, meaning that by the end of the 10 months, your full £10,000 has been invested. But this strategy has an advantage that if the market fluctuates and in particular falls, then you will be buying more of the shares or units in funds that you're investing in at a lower price. So your money gets more bang for its buck. And then when the market recovers, then those shares or units you bought at a cheaper price will obviously rally in value. And theoretically, in certain circumstances, you can actually make more money than if you'd invested your funds up front in one lump sum. But of course, there are circumstances where that isn't true, because if the market just rallied straight away, then you would have been better off investing your money as a lump sum. I mean, this is hindsight, and we'll put a link to a recent piece we talked about pound cost averaging on the podcast and some research around it. But what it highlights are different strategies that people can use, and it's up to the individual to pick the one they feel most comfortable with. And there is another type of strategy that I've never spoken about on the podcast, but I think some people would find this interesting, and it's called value averaging. So value averaging is a strategy that involves periodically adjusting the investment amount that you put in based on a target value that you're aiming for at some point in the future. So the main objective of value averaging is to achieve a predetermined target value over time, regardless of the market conditions. So that is different to pound cost averaging, because pound cost averaging is that you drip your money in equal installments over time, and you're aiming to make as much money as possible over a period of time. With value averaging, you've got a target number you're going for, and that has an influence on the actual amounts that you put in. Let's say you're doing it monthly from month to month. So the next point is you need to determine how often you're going to invest and how much you plan to invest each month to hit your target. So let's say that £50,000 in 10 years' time. Now, one of the key metrics or assumptions you've got to make when value averaging is that you've got to determine an annual rate of return. And now that needs to be realistic, because that determines how much money you're going to have to put in each month to potentially get there. Now, I am going to put a link to a website where you can download a spreadsheet that has the calculator in it that can help you determine the numbers. But let's say you go for 8% per year. That will determine the rough monthly contributions you need if you're going to get 8% return on a consistent basis. Now, if you imagine in your head, as you're putting your money in, your portfolio is steadily going up over time. The reality is the market doesn't do that. The market fluctuates and your portfolio value will fluctuate. So in the example that I've given, and we use the assumptions that I made, a target monthly contribution rate would probably be around about £280 a month. And with that 8% return, and you're assuming you're not increasing the size of the contributions at a consistent rate each year, like you're not inflation protecting them or anything like that, then what would happen is at each stage you would check the value of your portfolio. So after 1 year, let's assume that the portfolio, based on my assumptions, it should be worth around about £3,680. Now, I'm going to assume it's not worth that and it's worth £3,195 because markets fluctuate. I haven't achieved the assumption that I thought I would, a steady 8% increase in the portfolio value up to that point. Now that means that there is roughly about £485 difference between those two numbers. That means, therefore, that is the amount that I need to invest that month. So I need to put in more than 283. I need to play catch up and put in that higher number into the portfolio that month. Conversely, if I'm ahead of schedule, then what that means is that you reduce your level of contributions, and theoretically you can actually reduce it down to zero. Or if your portfolio is that much bigger, what you would do is you would actually sell down and bring your portfolio back in line with where it should be. So if your portfolio was £200 ahead of where it needed to be, you would actually sell £200 out of that portfolio to get it back on track, and you'd keep that money aside in case you need to put it back into the portfolio at a later date to make your money work harder. Now, you will have realized that what is happening is that this method consistently adjusts the amount you put in based on the portfolio's performance, and it aims to optimize the returns over the long term. So there are some advantages of this way of investing. Now, one of them, it enforces a disciplined behavior, because what you're doing is you're buying more investments, you're putting more money into your portfolio, so a higher contribution when it's falling behind where it should be. So you're buying into the market when the market's low, and when your portfolio is ahead of schedule, you sell out at a higher rate and keep that money to one side. So you buy low, sell high. Now that is obviously the optimum way to invest, but it's very difficult to do. Now it does provide a systematic approach to doing this, and it does take the emotion out of the decisions. The one thing I would add though is obviously very time consuming and a little bit tricky to do, because the initial setup, you need to know the position that the portfolio should be based upon your assumptions that you put in at the start. Hence why we've linked to a calculator that can do those numbers for you. And you need to put in a realistic assumption for the growth rate at the beginning, because if you put something that's too high, then what you'll find is that at the start your contributions will be quite low, but then you'll suddenly have to keep ratcheting them up because you're falling too far behind and it won't be sustainable. But one of the downsides, of course, beyond just the monitoring of the portfolio size and how much you have to put in, pound cost averaging has none of that. You just set it to work and let it go. There is an assumption, if you use value averaging, that you've got this cash pool you can call upon to invest extra money into your portfolio when it's running behind. And if you don't have that money, then this approach clearly will be difficult for you to do. Now, in uncertain and volatile conditions, you can find yourself having to make lots of adjustments. But of course, in certain conditions, this type of approach can outperform, and it can outperform pound cost averaging when you get significant fluctuations in market conditions. And if you get periods of market decline, then value averaging can enable investors to buy more at lower prices, potentially leading to higher returns when the market recovers. So there is an element of luck in this to do with the timings of your contributions, as there is with pound cost averaging. If the market falls with value averaging, you are putting more money to work than you would do with pound cost averaging, where the size of contributions are consistent throughout. And like all of these strategies, with the benefit of hindsight, the value averaging approach can potentially produce high returns compared to a traditional buy and hold strategy if it's executed effectively and the market conditions fall in its favour. So I thought I'd bring this to the podcast because I think there are going to be some people who are interested in this style of approach. There are a lot of people who are quite interested in pound cost averaging. This is just a different approach where you change the size of your contributions based upon market performance and fluctuations. Who would be attracted to it? Well, those people who are trying to invest for a fixed amount at this period in time and that are happy with taking risk. Obviously, when markets fall, they've got to put more money to work. So an interesting concept there, Andy. For anybody else who wants to find out more information, we'll put a link in the show notes that will explain the whole concept in even greater detail, as well as that spreadsheet that I mentioned.
Okay, so let's move on to the next piece of the podcast then. And Damien, you've been out and about doing a number of live events in recent months. And so you're just going to quickly go through some of those topics that you've covered for the podcast listeners.
Yeah, so I know that not everybody can get to these live events. If you can, it's fantastic to meet people at them. But I thought it'd be useful actually to go through the questions, because in every one of these live events, we have periods where the audience can interact and ask questions, which I always find really exciting. I like that interaction. So I'm going to go through some of the things that have come up in these events that I think people will find useful, because I obviously see people when they start scribbling down notes. So if you're scribbling down notes, I'm thinking, well, what I've just told them, they've obviously found that very useful. So I'm going to go through some of these bits and pieces now. One of the things that came up on a recent show that I did was about the amount of money you need for retirement, so a decent standard of living. And I think we touched upon this quite some time ago, a couple of years ago on the podcast. Now, I know that all of you who listen go back and listen to all of our episodes, but just for the one or two of you that don't go back and listen to every single episode, here are some numbers. So the Pension and Lifetime Savings Association did some research, and they looked at the amount of income single people and couples would need for different types of lifestyle and retirement. So for a relatively minimum lifestyle, a sort of minimalist one in retirement, a single person needs £10,200 a year. A couple, that increases to £15,700. For a moderate lifestyle, then that is £20,200 for a single person, and for a couple it's £29,100. Now if you want a comfortable lifestyle in retirement, then a single person needs £33,000 a year and a couple needs £47,500. So those numbers are useful if you want a finger in the air, very broad numbers that you might want to work towards. And of course this gets back to the next topic that often comes up, and it's to do with withdrawal rates from a defined contribution pension. So let's let's imagine you get to retirement, you have a defined contribution pension. So that's the one where you're paying in money every month, hopefully, and it builds up over time. Now, what is a sustainable rate to withdraw money from that? Now, the 4% rule that's out there is broadly based upon a mixed portfolio of assets, broadly 50% bonds, 50% equities. And if you drew money down from that once you got to 65 at a rate of 4% per annum, so you took 4% of the portfolio value every year, then that would be seen as a sustainable rate at which you wouldn't run out of money in retirement. Now, I have paraphrased that somewhat. If you go to podcast episode 210, we did a piece on debunking the 4% rule. And I've listened to that again. And in that show, to give you the highlight, the 4% is very dependent on how your money's invested and your own circumstances, including when you retire. And broadly speaking, a more realistic rate is somewhere between 1.8 and 3%. Now, the point is that we all need to look and go for a conservative approach when we're looking at withdrawal rates. But 4% has been the conventional number for a while. So it's going to be very dependent on your own lifestyle, how much you want to spend in retirement. Now, what people have forgotten about is annuities. So annuities are coming back into fashion when it comes to retirement planning, because if you go back to early 2022, you could get an annuity of about 3.5%, I think it was, for a 65-year-old. And the rate you get on an annuity depends on the annuity itself, whether you have guaranteed periods and different things. But I'm just giving you a broad idea. Since gilt yields have rallied significantly in the last year, and that's because of the high interest rate environment that we're in. Now, what we've got is that annuity rates are up nearer 7%. And you can get even more than that, obviously, if you're older than 65, but also if you have a health issue of some kind. So that is a significant difference. 7%, that means if you have a £100,000 pension pot, you could get 7%, that's £7,000 a year in income for life until you die. That is why people are looking at annuities. Don't forget that when you have a pension pot, you can take UF Plus, you can take the lump sums out of it. And I'm not going to get into the details of how that's taxed. I'll put links in the notes of this show where people can find more details. You can use drawdown. So you move some of your money into drawdown to provide an income and take some tax-free cash. But you can obviously buy annuities, or you can do a combination of all of those. So there is a podcast, episode 348, where I talk about when to buy an annuity. A very interesting piece on that show, which talked about the age that was the optimum time to buy an annuity, and the optimum was based upon soft facts as well, not just mathematics. It was based upon when people deemed them to be better value and whether people wanted to pass money on to their next of kin, etc. What were their priorities? So the other thing that you need to think about is what your retirement's going to look like. And everybody asks me at these shows, how do I go about doing that? Well, there's pension calculators, which we link to in the notes of this show, and you can use those to put in how much money you've got in your pension, how much you're going to contribute, and see how much income you can get in your retirement. Now, what I would also suggest people do is go and think about what they want their retirement to be. I often find that people glaze over when you say that to them, because it's very hard to visualize what a good retirement would look like. So what I do is often say to people in these shows is think about what you want it not to be, and then work back from there. And so you know what you don't want your retirement to be like, and you keep going until it gets towards something that you do want it to be, and you will probably scale back lots of things in terms of unnecessary stuff that you thought you would want, and focus on the things that really are important. Then you can work out how much that will cost a year, and then you can start to play with the calculators to work out how much you need to put in, but also work out that return on investment, that annual rate of return that you'll need in order to try and get towards the goals that you want with the money you've got available at your disposal, including the money that's in your pension pot already, but also the contributions you could potentially make. And hopefully that annual rate of return is realistic. If not, then you need to dial down what your retirement dream is to make it more realistic. The key thing is you need to have conversations about money with your partner, for example, if you're getting into your mid-50s, and thinking about what retirement might look like and when you can actually retire. One of the things that always comes up is about auto-enrollment, and explain to people how it's free money. So if you enroll into your company pension scheme, you put 5%, your employer has to put 3%, but also don't forget you get the government tax relief as well. So there is free money there. So always, if you can afford it, join your company's auto enrollment scheme, and hopefully your employer matches your contributions, so you at least got 5 and 5. People ask, how much should you put into your pension each month? I mean, again, it depends on your circumstance. There is that rule of thumb, half your age. So you take your age, divide it down by 2. That's a broad percentage of your income you should be putting in. So if you're 40, it's 20% of your income. That is a very broad number. I did point out to people about the importance of starting early in the show yesterday that I did. So give you an example. If you're age 25 and you put in £100 a month into your pension, your employer matches that, and you're lucky enough to get that match, and you have an assumed growth rate of around 7 or 8% per annum, you decide to retire when you're 65, then the power of compounding means that you would have around about £500,000 in your pension by the time you're 65. That's 40 years. Now, I've not assumed you've increased your contributions in any way, so you're not paying more than £100 a month, but it shows you the power of compounding. You've only put in just under £100,000 into that pension pot. The difference is if you had waited, say you were 45, and you then decide to do the same thing and think, I need to start saving for my pension, I need to put in the money, so I've got the same amount as the guy who was 25 who started, so I want to have $500,000 in my pension pot by the time I'm 65. The amount you've got to put in each month is not twice theirs, because you might think in your head, logically, they're doing it for 40 years, I'm going to be doing it for 20, I've got to put in at least twice. The answer is you have to put in 5 times as much as they are. So you're going to have to put in £1,000. So £500 from you, for example, maybe £500 a month from your employer. So that shows you the cost of delaying starting your pension. Now, there are obviously people who we talk to at these shows, and I'm very conscious that you always tell people to start early. What about most people who started too late? Now, I always talk about unconventional retirement. We are approaching a world where I don't think retirement's going to be quite like it used to be. I always talk about the idea that if you started a pension late in life, then you could try to build a huge pot by aggressively putting money aside. That is one way of doing it. But when you've got a very limited amount of time, yes, you'll benefit from the tax relief from the pension contributions. But if you, for example, built £100,000 pension pot, then even at today's annuity rates, that will give you about £7,000 a year, roughly. So let's assume that you could even do something like that with drawdown. If instead, as you are later in life, you use your contact book and you use your knowledge and your experience and expertise, and perhaps you've got a hobby or a passion and started following that, and you only have to generate £580 extra a month from that hobby eventually by the time you retire, that would be the equivalent of £7,000 a year. So that is doing something you love and making it generate potentially some income. You haven't had to put away £100,000 pension pot to generate that £7,000. You're just doing something that you love, and you've over time managed to get it to a point that it can generate that amount of money. It might take you 10 years to get to that point. What I want to do is just give people some light at the end of the tunnel. And I always, when I talk about this at events, I can see some people's faces light up a bit, because it is a little bit depressing when people just tell you you've got to keep putting money in your pension pot and it's too late for you. Well, there are other things that you can do. There are obviously people out there who want to try and put as much money in their pension as possible. Then you can use carry forward rules, where if you've maxed out the amount you can put into a pension this year, so that's £60,000, you can carry forward the last 3 years unused allowances. So if you've not used them, you can bring them forward. There are rules around them. We'll put a link in the notes of the podcast to it. The one thing I would say, if you're planning to not contribute to your pension at the moment, let's say you're a freelancer and think, well, in a few years I'll really ramp up when I've got going and I'll put money in my pension. You do need to have been in a pension. You have to have a pension that's open at the point that you want to carry forward from. You can't decide, oh, I want to open a pension today. You've not had a pension before and you're going to use the carry forward rules and use the unused allowances from previous years. You can't do that. So you will need to open a pension now if you want to take advantage of those rules. Another podcast that's worth drawing people's attention to is episode 372, which is about retirement spending truths. That was an episode where we talked about how your spending habits can change through retirement. So there are lots of assumptions that people make about how much money they will need or how that will vary. And in that episode, we talked about some research that shows that the amount of spending goes up by about 1% a year after inflation. So take inflation out of the equation, then your amount you're going to spend creeps up slightly until you're about age 80, then it starts to drop down. But more importantly, the stuff you spend money on changes. So it's holidays ultimately and things like that, the sort of golden period of retirement for a lot of people. And then later on, they spend more money on things like services. So that would be people perhaps who come in and help cook, clean, or do the gardening. So that's an interesting episode to listen to, because I think it will give people a realistic assessment of what retirement might look like and what they should plan for. One of the other topics is freelancers. We get a lot of freelancers at these events, probably because they can turn up and not have to ask for time off work. But questions about freelancers and pension contributions are popular because obviously they don't benefit from auto enrollment. But the key thing is, the message always has been, make sure you are putting money aside. Now, some people who are freelancers might put money aside in a separate pot, not put it into their pension until the end of the tax year, for example, but ultimately they're still trying to make those pension contributions. And of course, it does reduce your tax bill. Now, people who are directors of businesses, they shouldn't forget about their own pensions. Often they'll worry about their employees because of auto enrollment, but forget their own pensions. I talked a fair bit about that last night when I was doing the live show. But one thing is, it pays to put a small amount aside each month into a pension. And of course, the company can do that directly, which is tax efficient rather than you taking the money out and putting it into a pension. Again, there is the maximum limit you can put in each year, which remains the same. So at the moment, it's £60,000, but you don't have the reference to income. So it doesn't matter about your actual earnings, whereas for personal contributions, obviously it's the lower of your personal earnings and that annual allowance which you can put in to a pension yourself. So that is an interesting piece. I mean, I could go on all day, but other things people often ask about the state pension. Do make sure you know your state retirement age. It does differ from person to person. Go and look at the state retirement age calculators that you can find online. We're always asked about, will the state pension still be around when they reach retirement? It's a difficult thing to say, but of course, politically, it wouldn't be the easiest thing to get rid of. But when planning for retirement, do think about the numbers with or without the state pension in there, so you can see that what would happen if the state pension is removed. Because if you can plan for retirement and have enough money without needing the state pension, then the state pension is a Brucey bonus. And of course, I know that is a best case scenario. A lot of people won't ever be in that position. A couple of last things. I'm often asked about how they invest their pension and the assets and about the risk tolerance. And lots of people don't seem to be able to work out their own risk profile. So obviously, a lot of these robo-advice propositions have tools that will do that for you, but you can go to myrisktolerance.com, which is a website that the back end of it is run by Finametrica, and it's the basis of which a lot of financial advisors assess clients' attitudes to risk. You can pay for one-off assessment, so that's something worth bearing in mind. And I'm always asked about financial advice. At retirement, it is the time when financial advice is really valuable because it can stop you making mistakes. There are lots of different options that you have when it comes to taking your income. I mean, I talked about earlier mixing annuities with drawdown, but also the way you manage the portfolio so it can last for retirement. Rather than investing for growth and taking chunks, you can invest for income. And so you could build a portfolio of, say, income funds that produce a natural dividend over time. That is something that a financial advisor could help you with. And if you don't have one you can trust, then go and look at a website called vouchedfor.co.uk, which is like the TripAdvisor of financial advisors. And they'll have customer reviews on there, and you can find one near you that offers the services that you require. And more importantly, make sure you talk to a number of financial advisors if you're going to use them, because you can compare their services, but also their fees.
Right, so let's move on, Damien. I know you could talk to the cows come home on these kind of things. You love going to these live events and meeting and chatting to people about these kind of things. Right, so on the last piece of the podcast then, we're going to be just briefly talking about house prices, because Halifax produced their monthly house price index data this week. Now, just to fill listeners in, there are a number of indices which we actually go into far more detail in an article we have on the Money to the Masses website that talks about house prices. We'll put links to that in the show notes. And so Halifax produced their monthly data, which was significant because it actually showed that house prices, when they compare year-on-year figures, had actually fallen for the first time since 2012. Now, obviously, it's been a long time since we've seen a year-on-year fall in house prices for Halifax, but it's significant because in the last couple of months, we've also seen similar figures coming through from Nationwide. So it's the first time that we've seen two of the major lenders that are now reporting year-on-year falls in house prices. Now, the actual falls aren't huge. I mean, when you compare the numbers, they're saying that average property prices were recorded at £286,500 for May 23, and when compared to May 2022, which is where they compare the year-on-year figures, it was 289,000. So it's a £3,000 fall. So yeah, it's not all bad news. The data still shows, for example, that house prices are £25,000 higher than they were 2 years ago and £5,000 higher than they were recorded at the end of last year. And that's of course based on average house price sales. And so looking further ahead to 2024, the signs are there that house prices are potentially falling because the Office for Budget Responsibility, the OBR, for example, recently published a property forecast alongside the spring budget that did predict that house prices were going to fall approximately 10% in 2024 when compared to their high in the fourth quarter of 2022 just gone. And so we don't often bring this kind of news to the podcast, Damien, because these things are up and down all the time, and what can you really do with the information? But I thought the figures were significant enough to bring it to the podcast this time, Damien.
So we don't, as Andy say, talk about things that are too contemporary on the podcast because we like to make them evergreen. But the reality is that most people's perception of wealth is based around their house price. And when I went to the event again yesterday and other ones and talking to people there and journalists there, everyone's talking about house prices and mortgage rates. And I just want to point out that every month I do a video on YouTube about house prices and what the latest indices, and not just the ones that Andy mentioned, a number of them, what they're showing. So if you're interested in where they're going, go and subscribe to our YouTube channel because I do it on there. I talk about what the indices show. Very short video, punchy, gives you the data. Of course, there have been lots of negative headlines or doom mongering about what's going to happen to house prices. Yes, we go back in history when interest rates were risen as aggressively as they are now, then we have seen double-digit falls in house prices. We don't know what's going to happen at the moment. Anecdotally, what I'm hearing from parts of the property market, it's different parts that are struggling versus others. So we're talking about house price groups. So if you're talking down the bottom end, then yes, first-time buyers maybe aren't coming to the market in the way they were before, because if they're hearing news stories about house prices falling, then they're sitting there waiting for a bargain. Also, between about 500,000 and a million, so we're probably talking about people in the southeast, that kind of band. I think the market is struggling a little bit there. I'm hearing again anecdotally there'll be other people out there who will say that's not the case. Where they are, they might not be finding it, but part of that is because mortgage deals are being pulled a lot at the moment. So rates are going up, the number of fixed rate deals are being pulled. Have a look at our newsletter because we talk about all this kind of stuff in our newsletter as well. Give all the latest stories. moneytothemasses.com/newsletter comes out every Sunday at 10 o'clock with all the best and biggest stories in personal finance. You can keep up to date with that kind of information there. So I think that's it for this week, Andy. As ever, do make sure you leave us a review. You can hear how happy it makes me, Andy, and the team when we get those 5-star reviews from you. Don't forget to join the Facebook group, facebook.com/groups/money to the masses. Also follow us on our social profiles. I spend most of my time on Instagram. So if you'd been on Instagram this week, you would have seen when I was out and about and seen me taking pictures of myself eating ice cream. So make sure you follow us on all of those social channels. So that means all there is left to say, Andy, is until next time.
Until next time.